Gold just delivered one of the cleanest institutional reversals on the chart. A massive sell-side liquidity raid was followed by aggressive displacement to the upside. But the real question is this: are institutions preparing for continuation or engineering a trap before another expansion move? Today we're breaking down gold using pure smart money concepts, liquidity theory, and institutional order flow. We'll analyze the higher time frame narrative first, then drill into the 15-minute execution model to identify where smart money is likely positioning next. Starting with the 1-hour time frame, the market structure overall remains bearish. Price created a sequence of lower highs and lower lows after rejecting the 4,580 premium zone. That tells us institutions distributed positions aggressively from higher prices. Notice how every rally into premium pricing was sold aggressively. Buyers attempted recovery multiple times, but each push lacked continuation. Institutions repeatedly absorbed buying pressure and defended the supply zones above. This sharp displacement lower is critical. In smart money concepts, displacement signals institutional commitment. Retail traders usually focus on indicators. Institutions focus on imbalance, liquidity, and efficiency of delivery. Here we can clearly identify a break of structure. Once price violated the previous protected low, the market confirmed bearish continuation. This is where smart money gained full control of order flow. Now pay attention to this low near 4,365. The market failed to create strong continuation after reaching it. That makes this a weak low, and weak lows attract liquidity like magnets. Retail traders often place stop losses beneath obvious lows. Institutions know this. That's why price frequently engineers liquidity sweeps below equal lows before reversing violently in the opposite direction. And that's exactly what happened here. Gold swept sell-side liquidity beneath a weak low, trapped breakout sellers, and instantly reversed with strong bullish displacement. That reaction is not random. That is institutional accumulation. After the sweep, price delivered aggressive repricing higher. This tells us institutions were no longer interested in lower prices. The market shifted from distribution into short-term reaccumulation. Notice the imbalance left behind during this expansion. These inefficient zones often become magnets for retracement because institutions prefer balanced delivery before continuation. However, price is now approaching a critical supply region. This area previously triggered aggressive selling pressure. That means institutions may either distribute again or engineer one more liquidity sweep above current highs. Above current price, we can see liquidity resting near equal highs. These highs are attractive targets because buy stops from retail short sellers accumulate there. Institutions rarely move directly. They first seek liquidity. That means a sweep above current highs into supply would create the perfect environment to engineer a bearish reversal. Momentum is also beginning to slow near resistance. The initial expansion candles were extremely impulsive, but recent candles show smaller bodies and weaker continuation, a classic sign of absorption. So the higher time frame narrative is clear. Gold engineered a sell-side liquidity sweep, accumulated positions aggressively, and rallied into premium pricing. But now price enters a decision point between continuation and redistribution. Now let's move to the 15-minute time frame and study the execution model institutions are currently building inside this structure. On the 15-minute chart, we can clearly see internal bullish structure developing after the liquidity sweep. Price formed consecutive higher highs and higher lows with strong displacement candles. This bullish change of character was the first signal institutions were shifting order flow. The bear structure failed, and buyers immediately seized control with aggressive momentum. Each pullback afterward remained shallow. That's important because shallow retracements indicate strong underlying demand and limited institutional interest in selling lower. There's still a mitigated imbalance resting beneath price. If gold retraces, this area becomes highly attractive for institutional re-entry into long positions. Right now, price is consolidating directly beneath liquidity. This is where institutions usually prepare either for continuation through expansion or a manipulation move before reversal. Liquidity is now compressed on both sides of price. Buy-side liquidity sits above the highs, while weak longs place stop losses beneath consolidation lows. Notice the rejection wicks forming near resistance. Buyers are still active, but sellers are beginning to absorb momentum. This creates the conditions for volatility expansion. Institutions love uncertainty. When retail traders become overly confident in one direction, smart money often engineers a move into liquidity before revealing the true expansion. If price sweeps above current highs into the supply region and immediately rejects with displacement lower, that would confirm institutional distribution at premium pricing. But if price accepts above the supply zone with strong candle closes and shallow pullbacks, institutions may continue repricing gold toward higher liquidity objectives. Now let's break down the highest probability institutional trade setups based on current liquidity positioning and structure behavior. The first setup is the bearish scenario. We want price to engineer a liquidity sweep above current highs and enter deep into the premium supply zone. The ideal short entry sits between 4,518 and 4,528 after a strong rejection candle or bearish displacement confirmation on the 15-minute chart. The stop loss should remain above 4,542 because a clean break and acceptance above that level would invalidate the bearish distribution thesis completely. The first target for the short setup is 4,465, the nearest internal liquidity and imbalance region likely to attract price during retracement. If momentum accelerates and institutions continue distributing aggressively, the extended target becomes 4,405, potentially even revisiting the weak low liquidity near 4,380. This setup provides more than a 1-to-2 risk to reward profile while aligning perfectly with higher time frame supply and liquidity theory. Now let's discuss the bullish continuation setup. Institutions already accumulated beneath the weak low, and this imbalance zone could become the next reaccumulation point. The ideal long entry sits between 4,440 and 4,460 after bullish confirmation candles or a lower time frame change of character. The stop loss belongs beneath 4,418 because a deeper breakdown below this area would suggest institutional buyers failed to defend the imbalance. The first upside target is 4,520, the nearest buy-side liquidity resting above the recent highs. If institutions continue repricing aggressively, gold could extend toward 4,580, revisiting the major 1-hour supply origin. This long setup also maintains strong asymmetric reward potential while respecting higher time frame accumulation behavior. Professional traders don't chase candles. They wait for liquidity events. Most institutional moves begin with manipulation before expansion. Never trade the sweep alone. The real confirmation is displacement. Strong impulsive movement reveals where institutions are truly committed. The highest probability trades happen when higher time frame narrative aligns with lower time frame execution. That's where institutional precision becomes visible. Gold is currently sitting inside a critical institutional decision zone. Whether price sweeps higher first or retraces into demand, liquidity will determine the next expansion move. If you want more institutional grade breakdowns using smart money concepts, liquidity, and professional execution models, subscribe now and stay ahead of retail traders. The next move in gold could already be loading.